Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Imagine earning money while you sleep without the roller coaster ride of the stock market. Today, we're diving into the surprisingly fascinating world of corporate bonds, the quiet workhorses of investment portfolios.
Wait, corporate bonds sound boring. How can they possibly be fascinating? Aren't they just some dry financial instrument?
Boring? Far from it. Corporate bonds are actually like the financial world's hidden storytellers. They reveal the health of companies, predict economic trends, and offer everyday investors a strategic way to build wealth that most people completely overlook.
That sounds interesting. What's crucial for potential investors to understand?
Corporate bonds actually come in two distinct flavors, each with its own unique risk and return profile. Understanding the difference between investment-grade and high-yield bonds is essential for making informed decisions about whether and how to include them in your portfolio.
Okay, so what exactly is the difference? I assume investment-grade bonds are the safer choice.
You're on the right track. Investment-grade bonds are issued by companies with strong financials and high credit ratings. Think household names like Apple or Procter & Gamble. These bonds generally offer modest but reliable returns and lower risk of default.
Got it. So they're kind of like the slow and steady tortoises of the investment world?
That's a great analogy. Investment grade bonds prioritize stability over flash. In contrast, high yield or junk bonds are the hares. They offer the potential for higher returns but with significantly more risk.
Exactly. High-yield bonds come from companies with weaker credit ratings. The higher yields are tempting, but there's a real possibility that the company could default on its payments.
Wow, so it's a bit like choosing between a reliable sedan and a sports car. More excitement, but also more chances of things going wrong.
That's a vivid way to picture it. Of course, the decision ultimately comes down to your personal goals and risk tolerance as an investor.
Well said. It's about aligning your investment choices with your overall financial strategy. For some, the stability of investment-grade bonds might be the right fit. For others, the higher potential of high-yield bonds might be worth the added risk. There's no universally right answer.
This is such an important perspective. It's easy to get caught up in chasing returns without fully weighing the trade-offs.
Definitely. It reminds me of our discussion in previous podcast episodes about diversification. It's really about finding the right balance for your needs.
Exactly. And of course, corporate bonds are just one potential piece of that bigger puzzle. The key takeaway is that understanding the distinct risk and reward profiles of investment grade and high yield corporate bonds empowers you to make more intentional, strategic choices about your investment portfolio.
Couldn't agree more. It's all about aligning your investments with your goals, time horizon, and personal risk tolerance. Equipped with this knowledge, you're better prepared to determine if and how corporate bonds might fit into your financial plan.
Let's build on our exploration of corporate bonds and dive deeper into what makes them such a unique investment option. We've talked about the two main types, investment grade and high yield bonds, and how they offer different risk and return profiles. But there's another crucial aspect to consider: how corporate bonds can fit into your overall investment strategy.
Absolutely. Corporate bonds can play a vital role in diversifying your portfolio and managing risk. Because they tend to behave differently than stocks, adding corporate bonds to a stock-heavy portfolio can help smooth out overall performance during market volatility.
That's really interesting. So even though bonds might not have the same potential for high returns as stocks, they can provide a sort of stabilizing force.
Exactly. It's all about balance and alignment with your goals. For investors prioritizing steady income and lower volatility, a larger allocation to investment grade corporate bonds might make sense.
That's a great point about considering individual goals. It's not just about chasing the highest returns, but about constructing a portfolio that supports your financial objectives.
Right. And I guess that balance might shift over time too, as our goals and risk tolerance evolve.
Definitely. Your ideal bond allocation in your 30s might look quite different than in your 60s. As you near retirement, for instance, you might increase your bond holdings to prioritize capital preservation and income generation.
That's such an important perspective. Investing is not a one size fits all or set it and forget it endeavor. It requires ongoing evaluation and adjustment as our lives and goals change.
This really underscores the importance of having a clear investment strategy and regularly reviewing your portfolio. It's not just about picking individual investments, but understanding how they work together.
Well said. Each investment decision should be made within the larger context of your overall financial plan. And while corporate bonds can be a valuable tool, it's crucial to also understand their risks and limitations.
That's an essential caveat. Could you elaborate on some of the key risks to consider with corporate bonds?
Certainly, credit risk is a big one. The possibility, however slim, that the issuing company could default on its payments. This is why understanding the difference between investment grade and high yield bonds is so important. Interest rate risk is another factor. When rates rise, existing bond prices typically fall.
So it's not just about the individual company's financial health, but also broader economic factors like interest rate changes.
Exactly. Navigating the corporate bond market requires a holistic view. It's about assessing both company specific and macroeconomic risks and opportunities.
And of course, consulting with a financial advisor can be enormously helpful in determining the right approach for your unique situation. Corporate bonds can be a powerful tool, but wielding them effectively requires careful consideration and ongoing management.
The key takeaway is that corporate bonds can play a vital role in a diversified portfolio, but their effective use depends on clear alignment with your individual financial goals, risk tolerance, and overall investment strategy. As with any investment, thorough research and professional guidance are invaluable. If you'd like personalized guidance, you can reach out to us at safesimple.com/contact. Let's build on our understanding of how corporate bonds can fit into an overall investment strategy. We've talked about the importance of aligning your bond allocation with your individual financial goals and risk tolerance. But there's another crucial factor to consider: the tax implications of corporate bonds.
Absolutely. Taxation is an aspect that often surprises new corporate bond investors. Unlike municipal bonds, which often offer tax advantages, interest earned from corporate bonds is fully taxable at both the federal and state levels. This means the interest you receive is taxed as ordinary income.
Okay, so let's say I'm considering a corporate bond paying 4% interest. How would taxes affect my actual return?
Great question. Let's break it down. With corporate bond, you pay both federal and state tax. But with treasury bonds, you pay only the federal tax. So if your state tax is 5%, you pay an extra 5% of the coupon payments in just state tax because you purchased corporate bond.
That's a significant difference. It really underscores the importance of considering tax implications when evaluating investment returns.
Definitely. It's not just about the stated interest rate, but the after-tax return. So even though the corporate bond had a higher interest rate in this example, the treasury bond could actually yield more after taxes.
Precisely. This is why it's crucial to always consider your individual tax situation when making investment decisions. Of course, taxes are just one piece of the puzzle. The choice between corporate and treasury bonds also depends on your risk tolerance, income needs, and diversification goals.
That's an excellent point. While tax implications are significant, they shouldn't be the sole driver of your investment decisions. It's about finding the right balance of risk, return, and tax efficiency that aligns with your overall financial plan.
So what I'm hearing is that successful investing with corporate bonds is about more than just chasing the highest interest rates. It requires a holistic approach.
Absolutely. It's about understanding your goals, assessing your risk tolerance, considering tax implications, and building a diversified portfolio. No single investment, whether it's a corporate bond or a stock, should be evaluated in isolation.
On that note, let's recap some key strategies for effective corporate bond investing. First, clearly define your investment goals. Second, understand the different risk and return profiles of investment grade and high yield bonds. Third, consider tax implications based on your individual situation. And finally, diversify across different companies, industries, and credit ratings.
I couldn't agree more. Corporate bonds can be a valuable tool for generating income and managing risk in a portfolio, but they require careful consideration and ongoing management. As with any investment decision, thorough research and consultation with a financial advisor can be invaluable.
And that brings us to the heart of the matter. Corporate bonds are not about getting rich quick, but rather about steadily building wealth over time through strategic, goal-aligned investing. With the right approach, they can be a powerful addition to many investors' portfolios. We've covered a lot of ground, from understanding the basic structure of bonds to considering their role in a diversified portfolio. Now, let's dive into a crucial aspect that often surprises new bond investors: taxation. We discussed this briefly earlier in the episode already. Let's use a more concrete example this time.
Absolutely. Understanding the tax implications is key to accurately assessing the real return on your corporate bond investments. Unlike municipal bonds, which often provide tax advantages, interest earned on corporate bonds is fully taxable at both the federal and state levels. This means the bond interest you receive is taxed as ordinary income.
So if a corporate bond has a 4% coupon rate, the actual return I get to keep will be less after taxes, right?
Correct. Let's illustrate with an example. Assume you're in the 24% federal tax bracket and 5% state tax bracket. On a 4% corporate bond, your after-tax yield would be approximately 2.84%. In contrast, a Treasury bond paying 4% would yield about 3.04% after federal tax, and it would be exempt from state tax.
That's a substantial difference. It really highlights how critical it is to factor in tax implications when evaluating investment returns.
Definitely. It's not just about the stated interest rate, but the after-tax return. So even if a corporate bond has a higher coupon rate, a Treasury bond could potentially yield more after taxes.
Exactly. This is why it's essential to always consider your individual tax situation when making investment decisions. However, taxes are just one piece of the puzzle. The choice between corporate and Treasury bonds also depends on factors like your risk tolerance, income needs, and diversification goals.
That's a great point. While tax implications are significant, they shouldn't be the sole driver of your investment decisions. It's about finding the right balance of risk, return, and tax efficiency that aligns with your overall financial plan.
So what I'm hearing is that successful corporate bond investing requires a comprehensive approach that looks beyond just chasing the highest interest rates.
Absolutely. It's about clearly understanding your goals, evaluating your risk tolerance, considering tax implications, and building a well-diversified portfolio. No single investment, whether it's a corporate bond or a stock, should be evaluated in isolation.
And that's the key takeaway. Corporate bonds can be a valuable tool for generating income and managing risk in a portfolio, but they require careful consideration and ongoing management.
Couldn't agree more. As with any investment decision, thorough research and consultation with a financial advisor can be invaluable in navigating the complexities and building a strategy that works for your unique situation.
Well said. Corporate bonds aren't about getting rich quick, but rather about steadily building wealth over time through strategic, goal-aligned investing. With the right approach, they can be a powerful tool in many investors' portfolios. Next, let's dive deeper into the practical considerations for individual investors looking to add corporate bonds to their portfolios.
Absolutely. While corporate bonds can offer compelling benefits, success requires a thoughtful, goal-oriented approach. First and foremost, investors need to clearly define their objectives. Are you primarily seeking income, portfolio stability, or a balance of both?
That's a great starting point. I imagine risk tolerance also plays a significant role in corporate bond selection.
Precisely. Investment grade bonds issued by companies with strong credit ratings offer greater security but typically lower yields. On the other hand, high yield or junk bonds issued by companies with lower credit ratings offer higher potential returns but with increased default risk.
So it's a classic risk return trade off. Investment grade bonds are like the tortoises, slow and steady. High yield bonds are more like the hares, potentially faster, but more prone to setbacks.
That's a helpful analogy. It sounds like aligning your bond selections with your risk tolerance is crucial.
Absolutely. Another critical factor is your investment time horizon. Ideally, it should align with the bond's maturity date. If you expect to need your funds before the bond matures, you might face interest rate risk.
Can you elaborate on that?
Sure, when interest rates rise, existing bond prices typically fall. This inverse relationship matters most if you plan to sell the bond before maturity.
Got it. So even if a bond itself doesn't default, shifting interest rates can affect its market value.
Exactly. That's why laddering bond maturities and holding to maturity are common strategies to manage interest rate risk.
Another essential strategy is diversification. Just as with stocks, spreading bond investments across different companies, industries, and credit ratings can help mitigate risk.
That makes sense. I remember from our previous discussions how diversification helps smooth out volatility.
Absolutely. While diversification doesn't guarantee profit or prevent loss, it's a fundamental risk management tool in any well rounded portfolio.
One final point I'd like to emphasize is the importance of ongoing monitoring. Corporate bonds aren't set it and forget it investments. Regularly reviewing your bond holdings, their credit ratings, and their role in your overall portfolio is crucial.
That's great advice. So, to recap, successful corporate bond investing involves aligning your selections with your goals, risk tolerance, and time horizon, diversifying across issuers, and regularly reviewing your holdings.
This has been incredibly helpful in understanding how to practically approach corporate bonds as an individual investor. It's not just about chasing the highest yields, but about strategic, goal-oriented investing.
Couldn't agree more. Corporate bonds can be a valuable tool for income and stability when used thoughtfully within a diversified investment strategy. And that wraps up our deep dive into practical corporate bond investing. Join us next time as we explore municipal bonds. Until then, happy investing.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.